All right, welcome to today's Explainer. We are diving into a really fascinating and, let's be honest, pretty controversial theory about income tax. The source material we're looking at claims there's a legal way to pay zero, and the key isn't buried in the tax code, but in U.S. banking law. Our job today is to unpack that argument. So let's just get right into it. So let's just put the big question right on the table. Is it actually legally possible to pay $0 in federal income tax? I know, it sounds kind of crazy, maybe even a little dangerous to ask. But the source material we're digging into today argues that the answer is yes. And it all comes down to how we think about the actual money we use every single day.
So why would anyone even go down this rabbit hole? Well, look at this number, $1.4 million. According to our sources, that's what the average American will pay in income taxes over their lifetime when you factor in inflation. When you see a number like that, you can understand why some people might start searching for a remedy, no matter how radical it sounds.
Okay, so here's our roadmap for this explainer. First, we'll look at where this huge tax burden supposedly came from. Then we'll get into the wild idea of two currencies. After that, we'll pinpoint the exact law this is all based on, see how it's supposedly put into practice, and then we'll wrap up by tackling all those skeptical questions I know you have. All right, Section 1. To even begin to understand this theory, the source material says we have to rewind the clock back to the birth year of our modern financial system. The entire theory really zeroes in on one specific critical year, 1913. Get this, this is the year the Federal Reserve was created. It's also the year the Revenue Act was passed, which gave us both the IRS and the income tax. The source argues this was absolutely not a coincidence. And this, right here, is the core premise of the whole thing. The source claims that the Federal Reserve, being a private entity, creates money as debt. The U.S. government borrows it and has to pay it back with interest. So where does the IRS fit in? Well, in this view, the IRS was created to be the muscle, the collection agency for that debt. The two are seen as two sides of the same coin. And you can really see how this played out. When this whole system kicked off back in 1913, the highest tax rate was just 7%. Fast forward to today, and that top rate is hovering around 39%. The source presents this jump as the direct result of that system born in 1913. Now we're moving on to Section 2, and this is where the theory gets, well, pretty wild. We're getting to the absolute core of the claim, the idea that there are actually two different kinds of U.S. currency floating around, and they play by completely different rules. Okay, this is it. The whole theory hangs on this one distinction. On one side, you have Federal Reserve notes. That's the cash in your wallet right now. The source says they're issued by the private Fed, they create debt, and they're what's subject to income tax. But then, on the other side, there's something called United States notes. The theory says these are issued directly by Congress, they're totally debt-free, and, here's the kicker, they are not subject to income tax. This one idea is the entire foundation for everything that follows. But if that's true, where's the proof? Where's the smoking gun? That's what Section 3 is all about. The source claims the answer isn't buried in the tens of thousands of pages of the tax code, which is where you think to look. No, it says the key is hiding in plain sight, in a totally different place. U.S. banking law. Now, before we look at the actual statute, we need to know this one key word: redemption. It sounds complicated, but it's not. In this context, it just means swapping or converting something from one type to another. You got to remember this word, because it's about to be very, very important. And here it is, this one sentence. This is from Title 12 of the U.S. Code, Section 411, and it's the entire legal linchpin for this theory. It says, Federal Reserve notes shall be redeemed in lawful money on demand. Now, the source really focuses on that word shall. They argue it's not a suggestion, it's not optional, it's a command. The theory is that this lawful money is that other, non-taxable United States note. Okay, so that's the legal theory. It's a big concept, but how would a person actually do this? How does it work in the real world? In Section 4, we're going to walk through the exact practical steps the source material says you need to take.
The process that's laid out is actually pretty straightforward. It's just 3 steps. First, you have to make the demand. This basically means creating a paper trail where you officially state your choice of currency for any money you receive. Second, you just have to keep the record of all these transactions. And third, you prepare the tax return, reporting the money you redeemed as an adjustment that lowers your income.
So what does making the demand actually look like? Well, the source claims it's as simple as writing some specific words on your financial paperwork. If you get a paper check, you'd literally write this phrase right above your signature when you endorse it. If you have direct deposit, you'd add this wording to your authorization form with your employer. This simple act is what supposedly triggers that conversion for tax purposes. And this, right here, is the payoff. This is how it would actually look on your tax form. You report your total income, just like always. Let's say it's $100,000. But then you'd add another line, an adjustment for a lawful money redemption for that same amount. And boom. According to this theory, your adjusted gross income, your AGI, drops all the way down to 0.
Okay, at this point, I am sure your mind is racing with 1,000 questions and, a very healthy amount of skepticism. So in our last section, we're going to tackle those big, obvious questions head-on, using the answers provided directly by the source material itself. First up, the elephant in the room. If this thing is for real, why isn't every CPA and tax lawyer in the country screaming about it from the rooftops? The answer, according to the source, comes down to one word: specialization. The argument is that CPAs and tax attorneys are masters of the tax code. That's their world. But this supposed remedy isn't in their world. It's in this totally separate body of banking law. It's like they're digging in the wrong haystack.
All right, here's the multi-million-dollar question. What happens when the IRS gets a tax return showing 0 income because of this? I mean, surely they've challenged this, right? Has it ever been audited?
Now, on this point, the source makes some pretty bold claims. First, it states that for this specific method, audits just don't happen. It says you might get a frivolous filing notice, but that's just a scare tactic, a bluff. And crucially, it points out that this specific Title 12 redemption argument is not on the IRS's own official list of what it considers frivolous. Finally, it shares stories of people who say IRS agents backed down once they were challenged on the law.
Okay, let's talk about the real world for a second. What happens when you go to buy a house or get a car loan and your tax return says you made $0 last year? And the answer provided is pretty direct. Yes, it absolutely has an effect. A 0 AGI makes getting a traditional loan from a big bank that only looks at tax returns really, really difficult. However, the source says you just have to change your strategy and go to asset-based lenders instead, the ones who care more about your actual bank statements and the cash you have flowing in and out.
So we're going to end on this final thought. The theory we've just unpacked does a lot more than just question taxes. It tries to completely redefine the money we use. It leaves us with this one really provocative question to think about. What if the most powerful tool for financial change wasn't some complicated loophole in the tax code, but was a law about the cash that's been hidden in your wallet all along?